Hello, everyone. Welcome back to another episode of the Weekend Charts. I'm your host, Charlie Bilello, bringing you once again the most important charts and themes that I'm seeing today in markets and investing. If you're watching this on YouTube, take a quick moment and hit that subscribe button for all the latest content from us. A lot of good content coming out in the next few weeks, so don't miss that. Hit that subscribe button today. What are we going to be discussing? So much going on. We're going to talk about the Fed, interest rate cuts versus interest rate hikes. What's actually more bullish? Small caps. Is this finally the breakout? Something we've been discussing for a few years now. Animal spirits unleashed. Another recession warning from the conference board. We'll look at that and the data there that they're relying on. Confidence is crashing in terms of consumers. This is a trend for a while, but as I've been saying, watch what they do, not what they say. We'll end with something positive, as we always do. That would be a record number of millionaires in the U.S. Here we go. Back to easing. Federal Reserve cutting interest rates as expected. I do my traditional here, tomorrow's news today, every time the day before the Fed meeting, predicting essentially what the Fed is going to do. And I'm doing that just on the basis of data, looking at the Fed funds futures and saying, what are they pricing in? And a day before the meeting, they were pricing in a very, very high probability of a 25 basis point rate cut. And every single meeting since 2009, the Fed's done exactly what those Fed fund futures were expecting them to do. So the Fed indeed did cut by 25 basis points. And they also, as I predicted here, it cited labor market weakness, and they signaled more cuts to come. So if we look at the Fed statement here, you can see they're saying the economy is slowing, so economic growth is moderating, job gains have slowed, unemployment rates going up to 4.3%, highest in over 4 years. Inflation is moving up and remains somewhat elevated, although, as I said last week, the Fed was going to dismiss this, ignore inflation, and really focus on the labor market. That's what they did here, saying the shift in the balance of risks is really why they're deciding to cut rates here 25 basis points. So focusing more on labor market weakness than elevated inflation. And in terms of the votes here, almost unanimous. I think surprising some people. Only one member, Stephen Mirren, saying there should have been a 50 basis point cut, so the Fed should be more aggressive. Everyone else on board with a 25 basis point rate cut. And what Powell said is he called this a risk management cut. So not that it was necessary based on the data, but maybe trying to get ahead of potential labor market weakness in case it's weaker than what it appears to be today. So calling this a different picture in terms of the labor market cooling off. But basically, a number of times he said unemployment rate is still low at 4.3%. So not a huge concern right now. And it's just a different situation where labor supply and labor demand have both come down, and they want to get ahead of future weakness by cutting interest rates. What I thought was interesting is in terms of their projections, the Fed added one more rate cut to this year, so really aligning with the market now. Market was pricing in 3 rate cuts, Fed was pricing in 2. Now the Fed is saying 3 rate cuts this year according to their dot plots, but that despite the fact that they actually see higher growth today than back then and no higher unemployment rates than back in June. So the Fed essentially saying the economy is better than they thought back in June. Inflation projections are unchanged. Growth is higher, but still they should cut interest rates one more time than they did back in June. So that really doesn't make much sense to me. And in 2026, they're expecting higher growth, lower unemployment, and higher inflation, and yet they're saying the Fed funds rate should end 2026 lower than what they were previously projecting. So 3.4%. And really that's the big disconnect now, is looking at 2026. Market is saying they're going to end the year below 3%, and the Fed is at 3.4%. But of course, a lot can change between now and then. A lot will change between now and then that are going to affect all of these projections. And really, the Fed funds futures are really predictive, maybe one meeting out, but really only when you get closer to that meeting. So we still have a little over a month until that October meeting. But as of now, over 90%, if it stays anywhere near this level, of course, the Fed is going to cut interest rates again. It seems very likely as of now that they will. And the market's projecting a move down to 3.75 to 4%. And if we go to the December meeting, not as high, but still pretty high at 80%. And so the market and the Fed now completely aligned for 2025, but 2026 we have this disconnect with the market expecting the Fed to be more dovish than what the Fed is projecting. And so what the market's going to be looking at, of course, is the inflation data and the employment data that are going to come out over the next month, and that will change this trajectory. But very interesting situation here where we have the Fed funds rate at 4%. If we're looking at the lower bound, you have the Fed cutting interest rates, expected to cut interest rates a few more times this year, but you have CPI at 2.9% and rising. So the Cleveland Fed's expecting a 3% CPI looking at the next reading. So what the Fed will be doing then is really cutting interest rates into rising inflation, something we haven't seen since 2008. If we're looking at all the periods where the Fed was cutting interest rates, and we said what was CPI at that point in time, it hasn't been above 2.9% with the Fed cutting interest rates since 2008. But back in 2008, when the Fed was doing that, you had a recession. You had the worst recession since the Great Depression, and you had a bear market with stocks down over 50%. Today, of course, very different story, as we'll talk about a little later. Stock market's at record highs, no recession as of yet, but yet the Fed is still easing monetary policy. And if we look at global central banks, it's really been a big story this year is cutting, easing almost across the board. And the Fed is simply joining the party here in terms of other central banks have already cut interest rates multiple times this year. This is the first cut from the Fed. And this week we saw the Bank of Canada cut interest rates again, Norway cutting interest rates, and other central banks like Hong Kong and Saudi Arabia tend to be tied to the Fed funds rate. So whenever the Fed cuts, they cut. So they cut this week as well. And Indonesia easing policy again. So if we look at the U.S. Fed funds rate, the real Fed funds rate minus inflation, we're a little over 1%. The market's saying that's going to go below 1%. So the Fed is going to join the Bank of Canada. The Fed's going to join the Bank of England in terms of lower real Fed funds rate. The Eurozone is negative in terms of the real Fed funds rate, and Switzerland and Japan are negative as well. So what the market's betting here is the Fed is going to get closer to the rest of the developed world in terms of easing monetary policy, bringing down that real Fed funds rate. But what is going to happen to long-term interest rates? As I said last week, the jury's still out there because the Fed is not controlling these rates directly. They're controlling short-term interest rates. So if you have a savings account or a short-term loan, you're likely to see those rates come down. But if you're looking at something like a 30-year mortgage rate, it won't necessarily come down unless we see longer-term interest rates fall. And since that first Fed rate cut last September, we're actually seeing higher long-term Treasury yields and higher mortgage rates. Now, mortgage rates entering the meeting this week were about 6.26%. So we're going to watch this in the next few weeks, seeing if this will rise. And it's really going to be dependent on what happens with this 10-year Treasury yield. Is it going to rise again like it did after the first Fed rate cut last year, or are we going to see a move lower? That's going to depend on investor expectations for inflation. So if investors are thinking that inflation is going to pick up here, we're going to see CPI move above 3% and continue to rise from there. You could very well see this 10-year Treasury yield rise. We also, of course, have the persistent deficit situation, national debt continuing to rise. That's putting upward pressure on this 10-year Treasury yield as well. So the Fed might end up cutting rates 3 times this year, just like they did last year, but we may not see mortgage rates materially lower. We could actually see them go up if we see long-term Treasury yields rise. So that will, I think, be the important thing to watch over the next few weeks. What is the action going to be in long-term Treasury yields and long-term lending rates like the 30-year mortgage rate? 2, what's more bullish here? This is a crazy question to ask because I think most people would say, of course, it's going to be rate cuts. It's not rate hikes. Rate cuts have to be more bullish because that's what everyone always says. The Fed cutting interest rates is a positive for the market. The Fed hiking interest rates a negative for the market. But what does the data actually suggest? Took a look here, looking at all the rate cuts since 1982, going back in time and saying, were the forward returns for the S&P 500 actually higher than any random time period during this period of time? And the answer, if we're looking at 6 months to 4 years, is actually no. The returns were actually slightly lower following rate cuts than any random period. If we go out 5 years, a little bit higher there, but pretty interesting. Not that returns have been negative. They're pretty close to the average returns, but I think that would surprise a lot of people. People would most likely have guessed that you see very strong outperforming returns following rate cuts. That simply hasn't been the case. Now, here's probably something even more surprising based on the prevailing sentiment, which is that rate hikes are bad. Certainly doesn't appear to be the case in terms of the data here. And if we look at what the S&P 500 has done following rate hikes, you could see actually outperformance over the next 6 months through 5 years. So really, it's a myth to say that rate cuts are bullish, rate hikes are bearish. They're both bullish from the standpoint that the stock market tends to go up following both of these events. But if we're just being objective here and saying which has been more bullish over the next year, is it rate hikes or rate cuts? Well, historically, it's actually been rate hikes. I think this is probably chart's going to shock a lot of people. 15% average return following rate hikes and 11% following rate cuts over the following year. So don't believe everything you hear in terms of the Federal Reserve and what's bullish and what's bearish. As I always said, say fight the Fed in terms of don't listen to the narrative about rate cuts, rate hikes, the central bank rate. It's not that it's not important to the economy, but as a stock market investor, historically, if you're being objective, it really doesn't matter. And there's no consistent pattern to say that stocks do well following easing or tightening. There's no consistent pattern. The stock market tends to be higher over 1, 2, 3 years, regardless of what the Fed is doing. And the only thing you can say really is that the longer you are invested in the stock market, the higher the probability is of a positive return and the higher the probability of a cumulative gain being much, much higher. So you can see here the average 6 months returns around 6% during this period of time. If you go out 5 years, you're at 80%. So that should be the message for investors. Really don't focus on the Fed as much as the media does, as much as I talk about it, and as much as interest rates are important for the economy. As an investor, it's really better to ignore this stuff. But what is the reason why rate cuts might not necessarily be bullish? Well, it really comes down to why is the Fed cutting interest rates? And if they're cutting interest rates because they see a recession coming, they see economic weakness, not that they could predict this because they really have a poor track record of predicting recessions, but if they're cutting interest rates because they see weakness in the labor market and they're worried about economic risks, and that ends up being a recession, ends up bringing down earnings, well, that is, of course, doesn't tend to be a bullish situation for the stock market. So as we saw back in 2001 when the Fed started cutting interest rates, and in 2007 when the Fed started cutting interest rates, you could see what happened here in terms of the stock market. We saw huge declines following those rate cuts, both of those periods of time. So does that mean that's the situation today? Of course not. Every time is different. The Fed started cutting interest rates a year ago. The stock market has rallied 19% over the past year. So it's already a different situation from back then. But really to say that the market is definitely going to be higher year from now, well, that depends on what's going on around this rate cut. Are we seeing economic weakness that's going to lead to a recession, that's going to bring earnings down? Well, then that would be a very different situation of the Fed cutting interest rates. So really what I say when it comes to the Fed funds rate is you don't want to see the Fed aggressively cutting interest rates. So huge rate cuts, and you definitely don't want to see the Fed going back to 0% interest rate policy anytime soon, because that would mean that we're in another crisis, which certainly wouldn't be good for the stock market. Let's talk about the small cap breakout here, because this is something really we've been waiting for the last few years. A lot of signs of it happening, and once you think that it's going to happen, we saw a reversal. So a lot of periods where we've seen extreme short-term strength in small caps only to see a reversal. But this is the first time we've seen small caps actually hit an all-time high since November 2021. That might sound crazy because I've been talking about all-time highs in the S&P 500 for a few years now, but this is the first time the Russell 2000 small cap index has closed at an all-time high. And the perception is, from investors at least, is that lower interest rates are good for smaller companies. So we actually saw on the day the Fed cut interest rates, small caps had this huge move higher, outperforming the broad market. But as I've said before, we've seen fits and starts in terms of small cap outperformance only to reverse course. We saw it a year ago, last November, huge outperformance only to reverse course. And you can see here during the tariff tantrum here, huge sell-off in terms of small caps, but they have rallied all the way back, finally at an all-time high. But if we look at the S&P 500, since the start of 2024, we've seen 84 all-time highs over this period of time for large caps. So small caps finally joining the party. So the question is this breakout for real? Are small caps going to continue to run? And are we going to see small caps outperform? Because this has been the longest period of underperformance for small caps in history here. Just a few months ago, we were talking about small caps being at their worst relative position since 1999. And if we look at large caps versus small caps, you can see here this large cap outperformance going on for well over 15 years in terms of large caps outperforming small caps, and some brief periods where that reversed. We saw that back in 2020 into 2021. We saw it last year very briefly, but here we are again with small caps over the past few weeks outperforming large caps. The question is it going to continue this time? And really, this is a question more in terms of mean reversion, valuation. Are we going to see small cap valuations expand here? Are we going to see large cap valuations perhaps contract? Are we going to see a type of mean reversion that people have been expecting for years and just hasn't happened? So let's look at some of the valuation ratios here, because I've been talking a lot about large cap valuations being at the higher end of the spectrum, especially if we look at large cap tech names, Mag 7 names. You're talking about a forward PE of around 30. If we just look at the S&P 500 overall, forward P is around 22. And if we look at small caps and mid caps, much lower, forward P around 16. So a huge disparity between the two. And that, really, you can see that on this chart here, which is simply looking at the difference in forward PEs between large caps, the S&P 500, and small and mid caps. You can see here the biggest spread that we've seen. You got to go back to 2000, 2001 period to find a spread this wide in terms of large versus small and large versus mid. So really, if you're making the case for small caps, the case would be on a relative basis, they're far cheaper than large caps. You're going to make the case that lower interest rates are going to help small caps, just as perhaps higher interest rates hurt smaller companies because they have higher levels of debt. And so lower interest rates would be good because their financing costs will go down. And that perhaps we're going to see a reversion to the mean in terms of these valuation ratios. And then beyond that, it's really a question of fundamentals, because there's a reason why these larger companies have a higher multiple today. It's because they have been growing faster, and the expectation is that they are going to continue to grow faster going forward. So really the question is, are we going to see a change in that regime where we actually see the smaller companies start to participate in terms of the underlying fundamentals growing at rates where we saw the Mag 7 and these other large cap tech names grow over the last decade? So it's a multi-part question here. We'll continue to watch this ratio. We saw, of course, this year a big reversion to the mean so far in terms of the ratio of U.S. versus international, with international stocks outperforming. And the one thing we said really was missing from this reversion to the mean was small caps versus large caps, but perhaps this is the start of something. It's too early to say. And as we said, the last few years, we've seen many times where it looked like small caps were going to start to outperform. They were outperforming for a brief period of time, only to revert back to that secular trend of outperformance. So really, this is a case of why you need diversification in your portfolio, because you can't predict the future. There will be a point when this ratio changes, when it turns, and at that point, you're going to be happy you had something else in your portfolio outside of the US, outside of large cap tech. But over the past 15 years, it's been a hard bet to predict when that turn is going to occur. You only know that in hindsight, which is why you have to be diversified in advance. And if you're thinking about your portfolio for the rest of the year, going into 2026, now is the perfect time to reach out to us at Creative Planning. Get a free wealth path analysis from us at creativeplanning.com/Charlie. Schedule a call or a meeting with us today. And at Creative Planning, we're in all 50 states, so we likely have a location right near you. Over 370 billion in assets under management and advisement, and we're here to help. So reach out to us today, creativeplanning.com/Charlie. Animal spirits unleashed. Of course, after the Fed's cutting interest rates, a lot of euphoria, a lot of pent-up demand where investors are extremely excited about this prospect of easy money coming back into the market. The market, of course, was already running ahead of that. The market doesn't wait for the Fed to move. Of course, they're anticipating that all year long, that there's going to be easing. And we saw huge gains in terms of asset prices before the Fed cutting interest rates, and that continued after the Fed cutting. So 100% of asset classes, in terms of major asset classes, in the green so far this year. We haven't seen that since 2019. Gold being the best performer. Worst performers, cash still up a few percent on the year, but some signs of risk appetite. One thing I'm looking at here is the ratio of consumer staples to the S&P 500. That actually hit its lowest level this week since December 2000. You can see back during the dot-com bubble, this really crashed, going right towards the peak in terms of March 2000. So it was really a coincident indicator back then, and it really fell off a cliff during that period of time. And really, consumer staples are names like Procter & Gamble, like Walmart, safe, boring, reliable companies, and they tend to outperform during periods of market weakness. They tend to underperform during periods of market strength, and when investors are excited about growth, excited about the economy. So you can see back in August 2002, when consumer staples were outperforming a lot, that was close to the bottom of that bear market. And in November 2008, close to the bottom of the financial crisis, you had them outperforming by a large margin. And today, opposite situation, investors' appetite, risk appetite going up, and you could see this extreme underperformance in terms of consumer staples. And if we're looking at credit spreads, is another sign that I often look at, but we're at levels today in terms of investment grade spreads that we haven't seen since 1998, 75 basis points above risk-free treasuries in terms of investment grade bonds and high yield bonds. 271 is the spread here, well below the historical average, which is above 5%. And earlier this year, we saw the tightest spreads that we've seen since 2007, not far from the record lows here. The record lows were back in 2007, 2.41%. So investors reaching for yield after this rate cut. So rates are going lower in terms of treasury yields, your cash yield. Investors viewing the default risk to be very, very low here. So they're going up the credit spectrum, buying investment grade bonds, buying high yield bonds, and driving that spread lower. And finally, getting back to the CAPE ratio here, looking at large cap US valuations here, we're about 40 now in terms of the CAPE ratio. That's the highest we've seen since 2000. Really, the only period where the higher CAPE than today was 99 and 2000. And the interesting difference here in terms of Fed policy is back then in 1999, the Fed started hiking interest rates as valuations were getting to extremes. And today, the Fed, as we just talked about, of course, the Fed is cutting interest rates. So safe to say we've never seen this situation before with the Fed easing with financial conditions so loose, with financial risk appetite so high. So could this CAPE ratio go higher? Could it exceed the 2000 peak? Of course it could. Records are made to be broken. But just be aware, this is where sentiment and risk appetite is today. Extremely, extremely optimistic in terms of valuations, reflecting huge, huge growth is expected to come in the next few years. in terms of what investors are betting on today. So it's no different than 2000, revolutionary technology, investors betting that growth would continue. Today, once again, revolutionary technology, investors betting that growth will continue. Let's talk about recession here. Another warning from the conference board. If we go back to 2022, this is something we talked about a lot because conference board was predicting recession month after month there in terms of their leading economic index here. And you can see what it was doing back then. It was in a sharp decline here in terms of the blue line. And what essentially happened was that they kept predicting recession well into 2023, and the recession never came. And so eventually they called off their prediction for a recession. And just this month, they put it back on, saying that the 6-month growth rate had reached a point where below it, they're saying that signals a recession. If you dig into why it's going negative here, why they're predicting a recession again, it's really not, of course, not based on the stock market or credit indices. As we just talked about, spreads are near record tights and the stock market's at a record high. So certainly not that. But if you look at things like ISM, which continues to be weak here, new orders, consumer expectations for business conditions, very, very weak here. The housing market still a drag here. We had the lowest building permits, I'll talk about this next week, that we've seen in years. Manufacturing hours worked. So things like that all being a drag, and this pushing this 6-month moving average to be negative, and saying that it's essentially a signal, a warning signal for a recession. Now, are these indicators broken is the question, or has something changed fundamentally? Because in the past, when you had this warning, pretty quickly you had a recession. In 2022, you can see here the warning, and again, they were calling for it for about 2 years. The recession never came, and now we're back in that situation today. I think eventually there will be a recession. Everyone knows that, but the question is, has something changed in terms of these indicators where they're no longer predictive of a recession? And do we have a different situation today because of the stimulus coming out of the federal government in terms of the deficits, because of the AI revolution? Is that going to kind of counteract these historical economic indicators to make them invalid? That remains to be seen. Perhaps 2022 was a false signal, and this signal will be right. But if we're looking at real time, at least for the third quarter, doesn't appear to be a recession. The Atlanta Fed is projecting over 3% growth rate as of now in terms of the third quarter GDP, and in terms of what people are betting on at Polymarket, they're betting on a very low probability of a recession this year, only 7%. That's down from 66% back in May. So if there is a recession coming, it doesn't seem like it started in the third quarter, despite the labor market weakness we're still seeing. Expected growth here in the third quarter, and many different factors driving that. But it'll be interesting to see if they change their index going forward, or they kind of stick to their guns here and say, no, a recession is eventually going to come based on these warning signals. So let's talk about consumer confidence here, crashing, consistent theme, but consumption continues to be strong. What gives here is really the question, because if you look at the University of Michigan, their consumer sentiment remains at levels where in the past, you're looking at an economy in a recession, you're looking at high levels of unemployment. Obviously, not yet the case today. If we exclude 2022, where we had that highest inflation rate since the early 1980s, really the economy's been in a recession every time that consumer sentiment has been this low in terms of this University of Michigan index, and it goes back to the 1950s. And what are the reasons why? If you dig into the data here, well, it's 2 reasons. Consumers are expecting higher unemployment over the next few months. If you look at here, really, these levels haven't been this high in terms of the survey since the financial crisis, and before that, you have to go back to the 2001 recession. So really, a lot of negativity surrounding expected job loss. And then the other second part, which may be more meaningful because of that 2022 example that we have, would be consumers are expecting prices to go up a lot over the next year, between 4 and 5%, inflation closer to 5%. And so really consumers are saying prices are going to rise here. I'm not happy about that. And there's a higher chance of me losing my job, which is why sentiment is very low. Now, are they doing anything about it? That's really been the question. Are they pulling back? Are they not buying in terms of retail sales? And the answer there continues to be no. No, they're still spending. So retail sales hitting another record high in terms of the last monthly data we got. And if we look on a year-over-year basis, retail sales up 4.8%. On a nominal basis, if we adjust for inflation, up 1.8%. So right around the historical averages. So really no sign yet of the consumer saying this is too much in terms of my expectations have become reality and I'm pulling back. So gloomiest consumer that we've seen in an economy that's still growing, with unemployment rates still low, with wages still going up. A very big disconnect here. And if we look at the Atlanta Fed, they're saying consumer spending still strong enough to contribute in the third quarter 1.85% to real GDP. So this will be interesting to continue to watch. It's almost amazing that we've seen consumer sentiment this low with the stock market hitting record highs day after day. That type of disconnect is crazy to see, because back in 2022, again, we had the highest inflation since the early 1980s. You had a stock market that was in a bear market, so you could somewhat understand low consumer sentiment levels back then. Today, much harder to to understand how consumers are getting to this level of expected weakness with the stock market at all-time highs. Usually, the two are very correlated. You tend to see consumers more bullish about their spending when stocks are hitting record highs, and the opposite. You only tend to see consumer sentiment this low when stocks are in a crash or in a recession, and not the case today. So a pretty incredible disconnect. We'll continue to follow it and really wait to see the hard data in terms of spending going down, because this sentiment really hasn't been predictive over the past few years of an actual slowdown in what consumers are doing. So they're very gloomy. I believe that sentiment, but I don't believe that they're actually doing something about it just yet. So I want to end, as I always do, with something positive. That would be a record number of millionaires in the U.S. Latest data from Fidelity Investments, which tracks this quarterly. Number of 401k millionaires. So just simply looking at the accounts, who has a balance above $1 million. And in the second quarter of 2022, 294,000 accounts. Second quarter of 2023, 378,000 accounts. Second quarter of 2024, 497,000 accounts. Second quarter of this year, 595,000 accounts, record high. Wonderful to see. And what I always say about what's the ultimate goal of building wealth? Of course, there's many different things you can do with your wealth, but the biggest thing that it affords you is the time and the freedom to do what you want to do what's meaningful in your life. And for everyone, that's different, but there's definitely a relationship here. Wealth affords you that ability, that freedom to do what you want with your time. So love to see a record number of 401k millionaires in the U.S. Because it means people who have more freedom over what to do with their time. Can't think of a better way to end than that. Thank you everyone for joining me on the Weekend Charts this week. Have a great weekend. If you're watching this on YouTube, hit that subscribe button. I'll see you next time on